Good day. This session focuses on the credit terms as part of the working capital and current asset management, setting the credit terms and also how to manage the credit terms. Okay. So credit terms will be dealt in this session, as well as the collection policy we'll also deal with in this session. And then in the next two sessions we'll focus on credit monitoring, and then in the last session on cash management. So the credit terms are the terms or the conditions that's offered to the customer. And those include things like the credit period, how long before the customer needs to pay their account. Then eligibility for early settlement discounts. Does the customer qualify for early settlement discounts? That's not by default that anybody would qualify for early settlement discounts. And the reason for this is that is a very expensive way of collecting your outstanding balances. Also, the credit limits forms part of the terms and conditions that's offered to the customer. What are the limits that they are entitled to buy towards, and how are these limits being managed and adjusted also. Any penalties should they not meet the credit terms and what they agreed to, and then also what are the actions that they could expect when there is a breach in any of these credit terms. And it's good to communicate this up front, to put it in the credit terms, so that there's nothing unclear about the approach that will be taken, and a customer can then not come back and say, but why are you suing me, because I didn't know you're going to sue me for this small amount. No sir, it is in your credit terms, there it is. If you're behind on the credit for, let's say, 60 days, our credit policy says then we are handing you over to the lawyers and for collection. There it is in the credit terms, you signed for it, and we're applying those credit terms and what we agreed with you. Credit terms has a direct bearing on the competitiveness of a company in their market, in terms of their competitors, as well as in terms of winning over customers. And the more favorable these credit terms are, obviously the more favorable potential customers might look at this and might swing their business to the company offering the more favorable terms. And these credit terms should be aligned with the industry standards. There are minimum requirements in terms of credit terms, and a few other things that's dealt with in the National Credit Act, which we'll deal with later on. But it's often good practice to align that with what's happening in the standard in the industry. Credit period. Now, unpacking each one of those elements, the credit period is the number of days the customer has in which they can pay, and that's between the date of the invoice and the final date that they need to pay. So in this example, 60 days, they have 60 days to date from date of invoice to the date of being paid. And it's good to indicate this on both the invoice as well as on the statement, that there are no uncertainty about when the payment is due, because that's one of the biggest issues on collecting, is or reasons why defaults happen is because customers don't know when they have to pay. And it sounds ridiculous, but that's one of the real elements in business that leads to defaults or late payments. It's because the customer didn't know exactly when the payment was expected. And we'll get back to this as well. Extension of credit period, what are the effects of that? We already dealt with that in one of the previous sessions, where we looked at an extending credit period will lead to increased sales, which will positively impact the profitability. Then it will lead to increased marginal cost of investment in accounts receivable, and that is because there are more and higher level open accounts, and that will have a negative effect on our profitability because of the cost of those fundings. And the last one would be increased risk because of customer defaults. More customers owe the company money at longer periods of time, and therefore the risk of defaults just increase, and that negatively impacts the profitability. Early settlement discounts, we said earlier, that's one of the more expensive ways of collecting this, and very often salespeople would think that by giving a 5% or a 6% discount just to get the money collected is fair, and it's not that expensive. Doing the translation in terms of what the actual cost would be to the company makes these type of actions fairly expensive. But the way that an early settlement discount works is normally, or if an example, the customer has a 60-day agreement, so they need to pay within 60 days after invoice, they would then get an incentive that if they pay, for example, in 30 days from date of invoice, they will get then a 0.75% discount on the gross invoice amount that they need to pay. So this is different from the cash discount at purchase. That's a transaction discount. This early settlement discount is already a debtor, already an outstanding accounts receivable, and we want to incentivize them to pay earlier. And the way to do that is to then allow for a short payment, and the short payment, or the portion that it's being short paid by, which is allowed and agreed by the company, or offered by the company actually, is then seen as the early settlement discount, and it's accounted for in that way in the accounting as well. So what is the objective of early settlement discounts? And that's to minimize the credit losses, to get the cash flows in earlier and ensure that the customers pay, and also incentivizing them to pay. We do, however, need to consider the cost of the discount. We already addressed that. Decreased marginal cost of investment in accounts receivable because collection happens earlier, and also a decreased risk in terms of defaults because the payments has already been received. Credit terms, in terms of the limits, credit limits, that's the maximum amount that a customer may buy to. And if we relate this to credit cards or clothing accounts, that would be a classic example where your clothing account says you may buy to 4,500 Rand at any point in time, so you can move inside the 4,500 Rand, but the limit, you may not exceed a total outstanding balance more than the credit limit. Unfortunately, what often happens in cases like or in companies is that the credit limits are managed by the accounts department and very rarely communicated to the sales department. There needs to be very good communication between the sales department and the accounts department, because the sales department would like to sell more and more and more, and the customer will accept an offer if it's made by the company, and then create a major issue if they are then declined because of insufficient capacity on their account. And they're going to throw the argument to the selling company and saying, but why are you selling to us if you know that we are not or we close to our limit? And that creates a dilemma in the selling company. So just consider those and make sure that there are good communication between the collections department, the credit department, and also the sales department. But credit limits, higher credit limits leads to increased sales volumes, and again on the negative side in terms of the additional investment and potential defaults. The collection policy, so that's the second part of the session, the collection policy, consists of two elements, and the one is more a preventative action and the other one a responsive action. So the preventative action, expecting the receipt of payment within the credit period. So there is an expectation that the customer would pay, and to fulfill that expectation, certain things needs to happen, and we need to ensure that the customer pays and understand what to pay. But we'll unpack that a little bit in the next slide. The second one is the following up on overdue accounts receivable, and there's certain actions that can be taken there as well. So dealing with the first one, the expecting the customer to pay. When expecting payments at certain points in time, it is important that the customer knows this. So they must know what the terms of the agreements are, and that does not only mean signing the agreement. They also need to be reminded on when to pay. So that should be on the invoice, a specific date. This invoice due on that specific date. On the statement, monthly statements, it must be very clear what the outstanding balances are and when each one of those balances are due to be paid. Very clear. And the success of collection starts with proper communication, a proper understanding of what and when amounts need to be paid. A very cheap and very effective excuse that a customer uses are often when invoices or monthly statements are incorrect. They start querying this, and it becomes a nightmare of resolving this issue, and in the meantime payments are not made. Because if we can't agree on how much I need to pay you, why should I then pay you? And therefore it is important that it's imperative that the invoices and also the statements are correct and as updated as possible in terms of recent payments received, recent purchases made, because the same statement is going to be used against the company saying, but there is still 300,000 rands of capacity that we can purchase from you, and now suddenly you're saying no, there is not. So what is the story now? Is it on the invoice, on the statement, or is it just a number that you're plugging from the air? You hear the arguments coming through. And then we're also saying that there are regular communication with the customer, continuous communication, clear communication, very friendly communication, and that leads to the success of collection and the successful accounts receivable book. On overdue accounts, the important thing is to respond as quickly as possible. As soon as a payment does not come through on a due date, immediate communication needs to go out. Not at the end of the month, immediate communication, because often it is a mistake on the or just an omission or an error on the side of the customer who needs to pay. So if they know about the outstanding balance and the outstanding payment and the overdue payment, they very often reconcile that and make the payment very quickly. Once it's set into the overdue for 30 days and the customer is only then engaged, then the risk of it becoming a problem is much higher. So what are the next steps? So once the initial communication has taken place, then it could be followed up by letters of reminders, demand letters, final demand letters, also telephone calls, calling the customer directly, calling the accounts department directly, requesting the payments, asking when the payments could be expected, making special arrangements if need be, and at least have the communication lines open. In higher account values, face-to-face meetings would be good, so that direct discussion can take place and that agreements could be finalized and specific dates for payments can be agreed. Then collection agencies and factoring. That is in extreme cases where these should be used, and not as a general rule, because normally collection agencies and factoring are not so sensitive towards the company's customers, and therefore might offend the customers or be very aggressive in their approaches. And if that happens, the customer is then lost because of the relationship that is being damaged. And then the ultimate step would be legal action taken against the company or against the individual, and that is a last resort, and then very often the customer is already lost by that time. So then once legal action is taken, and legal action should not be postponed. And I think we need to be clear about that. Legal action, if it needs to be done, it needs to be instituted as early as possible. Based on what? Based on those immediate communications and the follow-up letters and the follow-up telephone calls. Those are all building into the case of the legal action. But trying to sue somebody if you never try to collect the money is very difficult. And also just bring into consideration that debt at some point lose their legal right of collection, and then we also need to look at that minimum number of period. So that brings us to the end of this second or the sixth session, and in the seventh session we're going to look at credit monitoring, how to monitor credit for a company.